Good afternoon, everyone. Hi, I'm Patty Hayes, CEO of AWS Foundation, and we have a great number of people signed up for today's conference. I hope we'll have equal numbers of questions coming to the good speakers that we've lined up. You will be on mute, so if you do have questions, use the chat function there on the bottom of your screen and type in your question. Adam, who already greeted us today, will then group those questions and direct them to the respective speaker at the end of the time. So feel comfortable also identifying which of the three speakers you'd like to have answer the questions. I'm just representing one of the four groups who have stepped up to bring this conference to you. We've all been flooded with information about COVID-19, and our thought was, let's talk specifically about the access we have to the funds, what legislation is there, and what are the things we need to know specific to not-for-profits. The four of us who have brought this group together is the Fullinger Foundation, as I say, AWS Foundation, the Community Foundation of Greater Fort Wayne, and the St. Joe Community Health Foundation. These topics are still changing. I'm amazed if they change the form one more time or there's another definition that's been added, but I think we've got a panel today that is going to bring you the most up-to-date information that we have on all of the information around the CARES Act. First, you're going to hear from Todd Haines, who is with Haines, Skiba, Haines, Isenbarger, Skiba. Always have to get those in the right order. A CPA firm that many of you know here in Fort Wayne. Tony Stites is here as a partner from Barrett and McNagny. We've known him over the years helping with a variety of HR issues and all employment matters. And Brett Chamberlain is coming on as our third speaker to cover those topics specific that we know from the payroll, paychecks, and deduction side. So with that, I'm going to hand this over to Todd as your first presenter.
Thank you, Patty. I must say it's, thanks to all our sponsors for helping to, pull this together. This went from inception to webinar in 1 week's time. And I think we've got close to 200 people registered. So just kind of amazing that we could do something like this that quickly. It's really the funders who are wanting to try and help the smaller nonprofits understand some of these changes. It's all come together quite quickly here just in the last couple of weeks. I'm going to, you're not accountants and attorneys, or most of you aren't anyways. I'm going to try and keep this at a very high level. More of an executive summary type thing. There's probably going to be overlap between the speakers, mainly because some of the topics do overlap. And we haven't practiced together, so I'm not 100% certain what Tony or Brent are going to say, but we'll have some Q&A at the end if you have some questions. So hopefully my goal today is to give you the sizzle. Then you'll want to go order the steak. It might have to be carry out for a while, but hopefully at some point you'll be able to sit down at the white tablecloth and see what the steak really tastes like. Some background on how we got to where we're at here today. It's literally only been 13 days since President Trump signed the CARES Act. And the whole purpose of the CARES Act was to try and keep the economy going. Clearly with stay-at-home orders and things of that nature, it's really difficult for the money to start flowing around, to where it needs to be. Unfortunately, the whole thing was drafted extremely hastily by the Senate. The House was going to have a competing version, which they opted instead just to stick with the Senate version. And then the president signed it quickly. Just to give you an idea, just the CARES Act alone is like $2.2 trillion, which is about half our normal federal budget for a year. So that's a lot of additional money. I'm guessing the printing presses are probably going 24/7 there in Washington. But it's a big stimulus, and we're looking at probably even more if you read the press. I'm going to focus today just on the Payroll Protection Act, the loan piece of that. And, keep in mind, this is something that didn't exist 2 weeks ago. And we've come a long way in the last 13 days on this whole program. But, as part of the CARES Act, they allocated $349 billion to give to the SBA to loan out to small businesses. And, they chose to do that through the local banks. The local banks are generally, the main way that the SBA gets money into people's hands. There is an emergency disaster loan, which is currently available from the SBA. We're not going to talk about that today, but that's somewhat mutually exclusive of this plan. And I think you'll find the payroll protection plan is probably the better of the two. Why are they using the local banks? I think mainly, one, to vet the borrowers. They want to make sure that, we're not giving out money out fraudulently. Anytime you've got a large government program, you've got that risk. So they're going to vet you. You're dealing with a loan officer, hopefully, that knows you, recognizes you, knows you're real. And then they're also going to use the banks to audit on the back end to say, okay, did you spend the money for the appropriate purposes that you were supposed to? Keep in mind, in a normal year, the SBA makes maybe 60,000 loans. And now we've said, okay, now we're going to ask you between now and June 30th to potentially give out millions of loans, via the banks. So it's a tremendous, multiple there of what the SBA is normally used to doing. And, unfortunately for the banks, they had 1 week's notice to do this. Treasury Secretary Mnuchin came out the day the bill was signed and said they were going to have it up and going by last Friday. That sounded like kind of a pipe dream at that point, but, bless their hearts, they managed to pull it off, and they, got the program going. So, it was really a Herculean effort on everybody's part to make that happen so quickly. The important thing about this whole program is these are forgivable loans. And I think, if you stop and think, in the nonprofit world, when I'm saying loans here, think restricted grant, because in essence, if you get a grant and you spend the money appropriately, that's, you don't have to do anything. You don't have to give any money back. And in essence, that's what we're looking at with these forgivable loans. They're basically saying, if you spend the money on the appropriate items that we want you to, mainly payroll to keep people's paychecks coming, then you don't have to repay these loans. And when they first started talking about this, I kind of did a double take or a triple take and said, this is one of those things we're going to be talking about 50 years from now going, can you believe that they did that? This is kind of one of those, better than sliced bread type of things where in essence, it's a loan, but as long as you spend it properly, you don't have to repay it. So it's like, that's, in the business world, that's about as good as it gets. So who can qualify? This was designed for small employers under 500 employees. There's some exceptions in the restaurant hospitality industry. But in addition, it includes nonprofits, our audience today, and it also includes the self-employed and also sole proprietors. And they can get up to a $10 million loan. You think, okay, maybe I'll just apply for 10 million, but that's not possible. The maximum amount that you can apply for is based upon your compensation. And so, it's, the drafting on this is a little sketchy, but, in essence, what they said was figure your average monthly compensation either for 2019 or now for the previous 12 months. Figure out what that monthly compensation number is, and you can get 2.5 times that. So in essence, they're willing to give you 2.5 months worth of compensation as the maximum loan amount that you can apply for. You also need to keep in mind that when they say compensation, it's limited to $100,000 per employee. So if I've got a vice president or somebody that makes $500,000 a year, then they're only going to count in the calculation to the extent of the first $100,000. So how is this whole process going to operate? First, you're going to fill out your application. The local bank's going to get it. They're going to, send it off to the SBA. They're going to get it approved. My perception is Yeah, the SBA is probably rubber stamping these. You can imagine, they've probably received several million applications just in the last 6 or 7 days. But now the good part is these loans are 100% guaranteed by the Small Business Administration. So from your banker's perspective, the bank has zero risk, which is much different than a normal SBA loan. And in addition to that, there's also a nice fee that the bank gets paid to process the loans. So, if you're the banker, you've got zero risk and you've got a nice reward. So it's like, why wouldn't you want to do this? From the borrower's perspective, there's no personal guarantees required. There's no collateral required. There's basically no recourse back against the borrower. So from the bank's perspective, from the borrower's perspective, this is as good as it gets. It's just, it's very far from their normal course of action, because it's not the type of loan they're used to dealing with. This is basically kind of free money to some extent. So once you receive the money, what's going to happen? The loan gets approved. The bank funds the let's say you borrowed $100,000. So the caveats are you've got 8 weeks, basically 56 days from the day you receive the money to spend it on the appropriate qualified items. And you say, okay, what are the qualified items I can spend it on? The main item would be compensation. That's the whole purpose of the program. But in addition, some of the qualified items also include rent, utilities, mortgage interest, some other minor things. And I think, the hardest part of this whole process is going to be there on the back end, where people are going to have to account for that money. That's where the bank's going to really earn their money. They're going to have to audit those numbers and say, okay, we loaned you $100,000. How much of that $100,000 did you spend on qualified items during that 8-week period? So we know how much is going to be forgiven and, can report accordingly to the Small Business Administration. And I've had a couple of people ask, well, why can I only borrow based on compensation, but then they're going to let me spend it on other things too? I think that's just the vagaries of, they probably were identical at some point, and at some point at 2 a.m. in Congress, the front part got changed to simply compensation, and nobody thought to change the forgiveness piece. So that would be my best guess. Okay, so how, if you're a potential borrower, how do you go about applying for this? The paperwork is extremely simple. I was guessing 5 pages. The loan application came out to a mere 2 pages, which seems unheard of from a government perspective. So you've got a 2-page application, which has got some signatures, some verifications, and then each bank is kind of asking for a little bit different. You're going to need calculations that show, for that 12-month period, what your employees earned. They're also asking for copies of quarterly 941 reports, your 940. Some of the banks are saying, okay, tell us how you're going to spend that $100,000 on which categories. So it kind of depends. They all had to kind of build this on the fly over a 1-week period. So things, it's kind of like I keep telling everybody, wait 12 hours, and the rules, they seem to keep changing on us. So hopefully enough dust has settled in the past week that's not going to keep happening. But that calculation of compensation is the whole driving factor on the front end on how much you can borrow. As I said, you can use 2019 numbers. You can say at this point, well, maybe I want to use April 1 of 2019 through March 31st of 2020. It was debatable which one they wanted, and Tuesday night the SBA said either one's fine. So they're finally starting to clear up some of that. Just simplistically, besides compensation, you can include some other things like health insurance you're paying for employees, workman's compensation insurance, in Indiana or state unemployment tax that you pay on their behalf. Some items which have cleared up in just the last week. It was debated, okay, if I make payments to an independent contractor, can that be included? If you'd asked me 3 or 4 days ago, I would have said yes. Now it's like, no, they finally cleared up that those payments do not count in the calculation. On the premise that the independent contractor can go apply for his own PPP loan if he desires. So the 1099 payments out are not includable. A recipient of those could get their own application going. The other thing that was really debatable for the last week was there's some bad language about federal withheld income tax or FICA taxes withheld. And I think they finally come to the point where they said, no, those are not, includable or excludable. So I think, Senator Rubio came out over the weekend and had a series of like 13 straight tweets basically saying that what was happening last Friday was not making sense with what the congressional intent was. So I think Senator Rubio took the SBA to the Woodhouse and made them understand what Congress really intended. Just Tuesday night, and the latest guidance that came out was where they said you should get the money within 10 days once the approval's received by the bank. I guess the key thing to factor in is every single bank is doing this differently. It reminds me of my wife likes to watch these cooking shows, and they'll have a competition, and everybody gets the same ingredients, and it seems like everybody whips up a different dish that it marvels me how the wide variety they can have, when everybody started with the same ingredients. So I think each bank's kind of cooking up their own recipe as we go here. Okay, now let's get to the important part, the forgiveness. Everybody's really interested in this part. Like I said, in the whole process, this is going to be the harder part, where the bulk of the work's going to happen on the back end when you have to account for it. If you've got good accounting records, no problem. If you got poor records, then maybe, some of the banks are actually requiring people to create a brand new checking account just to put this money into. One of the rules that they made up out of thin air a few days ago was that in terms of the rent, utilities, for the non-compensation items, they're only going to allow you to forgive, up to 25% for those non-compensation items. That's nowhere to be found in the actual act itself. They just, I think, decided we're gonna make that as an arbitrary limitation. So if your goal is to get 100% forgiveness, you're gonna have to spend at least 75% of the money for compensation-related items. Some other caveats, and this goes with the whole concept that they're doing this to try and preserve jobs, is you must maintain employee levels comparable to where they were in 2019. So, if, let's say, your workforce goes down by 20%, you're going to be looking at a pro rata 20% reduction in the amount that's forgivable. So you want to keep employment levels high. There is a provision where you've got a chance to cure that. Let's say you've already laid some people off. If you can bring employment levels back up by June 30th of this year, and how that applies, it's really, there's not much guidance there. So, just be aware that you've got a chance to kind of revamp, re-up your workforce to try and comply with that provision. The other thing that's kind of hidden in there is you don't want the employees' compensation to fall below 75% of what it was prior, or they may not be includable in the calculation. So those are a couple of things that aren't getting a whole lot of play, but they are out there. So let's say, by example, I borrow $100,000 and I only spend 85% of it on qualified items. What becomes of that last 15%? Okay, in that case, it truly does become a loan. Excuse me. So that final 15% is going to convert into a loan that can go out as far as 2 years at a whopping 1% interest. And that being said, they've already changed interest rates and loan period on us several times in the past week. Hopefully those will stay set. Although the latest debate I saw was, is it 1% simple or 1% compound interest? I don't think that's going to make much difference one way or the other. I think the one thing that is clear is on the forgiveness side, there's going to have to be more guidance come out in the next 8 to 12 weeks. But everybody's been scrambling here for this past week or two, just trying to figure out what the front end process was. So clearly they'll have a chance to do that. All right, what are some of the things that you should consider in this whole process if you want to obtain the PPP loan? And these next two, these are things that I think Tony and Brent are going to discuss. But there's a new provision that allows employers to defer the 6.2 piece of employer FICA, and pay it 50%, each at the end of the next 2 years. If you choose to do the PPP loan, you can't take advantage of that deferral. There's also some new retention credits available to employers. The PPP loan would preclude you from doing that. So, those are somewhat mutually exclusive. Another concept that's kind of opposite of the loan process is some of the other COVID legislation provided that between now and July 31st, the unemployed can get up to, or not up to, I guess they can get $600 a week of federal unemployment benefits on top of their state unemployment benefits. And it's my understanding that that money has not started to flow yet to the unemployed. But I know some people were saying, well, let's lay the employees off. And there was a story in the Wall Street Journal yesterday where some of the firms were giving, the chance for people to voluntarily lay themselves off because with state unemployment and the $600 a week of federal, they were going to make more money being unemployed than they were if they were actually working and drawing a paycheck. And I know I heard Lindsey Graham yesterday on the radio as I was driving. He was railing mightily about that in his mind, that there should not be an incentive to not work versus working. So we'll see how that shakes out, but just keep in mind that keeping employment levels up may preclude people then from getting that extra federal unemployment money. Okay, so what's your next step then at this point? I think the important thing is timing. You got to keep in mind there's limited dollars, and although 349 billion sounds like a lot, some of the big banks have been touting like, oh, we processed, so many, loans. So, the 349 billion, I believe, is going to be gone long before we get to June 30th, which, begs the issue is like, okay, is there going to be enough political pressure to get Congress to put more money into the program? The last I saw, President Trump was proposing another 250 billion to go into this program. Whether that happens, I guess, depends on, congressional agreement. But I think there will be a lot of pressure to put more money in, but obviously there's no guarantee. So if someone decides to wait till the bitter end and the money ran out on May 27th, then, once it's gone, it's gone. So keep that in mind. So I think if nothing else, you want to consider this soon if you think this is something you want to do. And, at the end of the webinar, if you say, I wonder how much we could get, all right, here's your quick rule of thumb. Pull out your 2019 numbers, see what your gross compensation was, and multiply it by 21%. And that'll give you a rough ballpark number of what you could borrow. It'll probably be a little bit more than that with some of the add backs, but I was on the phone with a client yesterday, and it was like they're looking at a $1.5 million loan, and it was they've got 300 plus employees also. So it's somewhat a function of how many employees and how much your payroll is. But if you have lots of employees, your potential loan could be huge there. My last caveat is simply work closely with your current banker. This is not a time to walk into a strange bank and say, you don't know me, but I want to switch banks and get my PPP loan here. The loan terms, they're identical. Each bank may have a different process, but it's become kind of clear this week that the banks have been very parochial. They're putting their existing customers first, and there's been some things where people, for whatever reason, couldn't go to their existing bank, and they're finding it difficult to find another bank that would not put them at the back of the line ahead of the current customers. So hopefully, if you've got bankers on your board, or I guess I'm just saying, don't switch banks for this. Stay with the tried and true and get the loan money through them, and you'll probably get the money much faster. So with that, I will turn it over to Tony Stites.
Okay, Tony Stites here. I'm with Barrett McNagny, LLP, a law firm downtown, and I'm going to take you through the employer aspects. Adam, I don't know, can we switch over to my screen?
Yeah, if you, at the bottom of your screen there's a little green button that says share screen. If you hit that and then select your presentation or the materials you'd like folks to see, that's probably the best way. Perfect.
Can you see me now?
can see the screen if you want to go navigate to what you'd like folks to see.
It's just going to be me. I just wanted my picture up there.
Then I will stop sharing your screen. Your picture will already be up there for folks.
Okay. Again, Tony states that I'm going to cover the HR portions quickly. As you know, the new laws under the Families First Coronavirus Response Act apply to employers with fewer than 500 employees. So normally the federal laws apply to employers of a certain size or larger. In this instance, they apply to a certain size or smaller. The 500 count to be exempted out, 500 or more to be out, is based upon the time that the request for the leave would take effect applies. So hypothetically, you run a chain of restaurants and you have 1,300 employees a month ago, and today you're down to 300, and I need one of these two type of leaves. I'm going to be covered, even though just a month ago you had well in excess of 500 employees. So it's the employee count at the time that the requested leave would take effect when I need my time off. The first one is called emergency paid sick leave. This is 10 days, now clarified to be basically 2 weeks, 10 work days of paid leave. I get paid for some of the reasons for taking this leave. I get 100% of my average wage for the 10 days, and for some of them I get 2/3. So let's just kind of walk through the ways I can get paid sick leave. The first way is that I have an order from the federal, state, or local governmental agency ordering me to quarantine or isolate. Then I'm eligible for my full pay for the 10-day period. I would note that originally, when this came out of the House, moved to the Senate, then went to the DOL for guidance, it looked like if you were a non-essential employer, potentially all your employees could get this type of leave. If they were a non-essential employee at an essential employer, they could get this leave. But it's very clear now that the DOL has made it clear that the individual employee, they themselves must be subject to a specific order that directs them, that employee, to stay home, not a generic order that closes their employer down or reduces the volume of business at an employer. The second one is for an employee who's been advised to stay home by a healthcare provider to self-quarantine due to concerns related to COVID-19. This is paid at 100% as well. I have a directive from my doctor that says I should self-quarantine, that I'm going to get the 10 days of paid sick leave. Third way is the employee is experiencing symptoms that are consistent with the COVID-19, and this is critical, is seeking a medical diagnosis. So I've got a cough and I call in my employer and say, I'm not coming in today, I got a cough, a fever, whatever it might be. I do not get emergency paid sick leave. If I say I have those symptoms and I'm going to try and get a doctor's appointment and go see my doctor, now I've triggered the right to paid sick leave, again at 100% of my average base rate. The next three are paid at 2/3 of my normal wage rate. And the first one of those is to care for an individual. And if you look at the act, seldom do we see such a broad definition of someone who I can take leave to help out for. But it says individual, which us lawyers would say would be every person on the planet. Luckily, as this worked its way to the Department of Labor, they indicated that an individual is somebody that you live with and would have an expectation that you would take care of them in such a situation. So the DOL has drastically narrowed that phrase, but it is probably broader, than immediate family member that you might be familiar with under the FMLA. But this is to care for an individual who's subject to an order. They themselves have been ordered by a governmental agency to quarantine, or a healthcare provider has told them to self-quarantine. The next way is to care for a son or daughter. That's going to be interpreted the same way it is under the FMLA. So a son or daughter whose school or place of care is shut down or unable to take them because of COVID-19. And then the sixth one, which in reality doesn't exist, but it's listed as a way to take leave, is the employee is experiencing other substantially similar conditions as defined by the Secretary of Health and Human Services in consultation with the Secretary of the Treasury and the Secretary of Labor, and there is no such cooperation and there is no such definition. So last night, the DOL finally conceded that item number 6 doesn't exist right now. Someday it might if those agencies ever get together, but as of today, there's really only 5 ways to take your paid sick leave. When I say full pay, it is capped at $511 a day. And when I say 2/3, that's capped at $200 a day. So those numbers may or may not come into play within your organizations. Full-time employees get 80 hours of paid sick leave, and full-time employees are employees who are regularly scheduled on average for 40 hours. And I had this question come up a few times. Hey, Tony, we schedule a lot of people for 40 hours and not all of them are all that good of an employee. And we got a few that don't show up more than about 32, 33 any given week. And unfortunately, the law is pretty clear that if you regularly try and get them there 40, they're going to get the 80 hours of paid sick leave. Now, keep in mind, when you're fronting this money, so to speak, you're going to get a tax credit for the paid sick leave monies you pay out when you file your next quarterly payroll taxes. So the government's got you fronting this money and then in theory is going to reimburse it if you're still in business by the time you file your tax credit request. Part-time employees, that's everybody who's routinely scheduled under 40 hours a week, get whatever their scheduled expectation would be in a 2-week period. So what do you routinely schedule me? If it's a fluctuating situation, well, we schedule sites all kinds of different hours. Then over the last 6 months, you basically can average how much have I worked in the last 6 months on average per week. Take that times 2, and that's how many hours I'm going to get for the part-time pay section. Question that's come up regularly is, can this leave be taken intermittently? And the short answer is yes, but the real answer is no. It's yes, only if the employer elects to allow somebody to take it intermittently. And so while this may sound cold and callous, I am a tainted old defense lawyer. I am strongly suggesting to my clients that they not allow it to be taken intermittently. Because once you allow it to be taken intermittently, I suggest you're going to have to let everybody take it intermittently, or you're going to face a discrimination claim under one of the other federal laws. So, unless you've got a small workforce and it works for you, overwhelmingly, my gut tells me you're going to be better served to just simply say no when it comes to intermittent leave. I think I've covered the dollar thresholds. As the employer, you cannot force the employee to use other paid sick time or other paid time off that you had available before this law was passed, but the employee can elect to use those other policies if they're taking the 2/3 leave to get themselves up to 100%. So whatever you had by paid sick time, or if you're in one of the jurisdictions that has specific paid sick time, that would come after the emergency paid sick leave under the Family First Act. Emergency paid family medical leave, same thing, applies to employers, private employers, most public agencies as well, that employ fewer than 500 employees. So now you've got an existing law that applies to companies or employers that have 50 or more employees for the first 5 ways to take FMLA. And now we're going to add one that applies to folks who have under 500. So we're going to have some employers, my guess in the room here, who are covered by the old FMLA and the new FMLA, right? You've got 50 or more employees for 20 more calendar weeks last year. And so you're covered by the old FMLA, and you're under 500, so you're covered by the emergency paid family medical leave. My gut tells me then we also probably have some who have under 50 employees. So you're not all that familiar with FMLA, and now you have to provide one very specific type of FMLA. The emergency paid family medical leave has been misinterpreted by many legal authorities and employers, and it's because when the House passed their version of the Families First Act, it mirrored the items that I just referenced for paid sick leave as being an additional way to get FMLA. Then it went to the Senate, and the Senate stripped it down fairly dramatically. And then it went to the Department of Labor, which stripped it down even further. So the only way you get FMLA, emergency paid family medical leave, is if the employee is unable to work or telework because the employee is needed to care for a son or daughter whose school or place of care, daycare, is shut down or unable to take care of them. That is the only way to get the expanded FMLA now, not any of the other items we talked about for paid sick leave. I should also note that on the paid sick leave, it applies to your employees the day you hire them. So you hire me today, and today I need paid sick leave, I get it. For the new emergency paid family medical leave, I have to have worked for you for 30 calendar days. And that's different than the balance of FMLA. To get the other types of FMLA, what I call the old FMLA, I have to have worked for you for 12 months in the last 7 years, and I had to have actually worked 1,250 hours in the last 12 months. Those two rules do not apply for me taking emergency paid family medical leave. Again, just to care for a son or daughter in those limited circumstances. And at that, for that leave, I get $200 a day. I get my 2/3 of my rate capped at the same $200 a day. Again, no intermittent leave allowed for this emergency paid family medical leave unless the employer agrees to it. So here again, I'm strongly recommending that you not allow, or you give serious thought to not allowing intermittent leave, because again, if you allow it for one, you're going to need to allow it for everyone. And this is going to be up to 10 weeks of additional time. The paid sick leave, again, clear from the Department of Labor, is designed to run concurrently with the paid sick leave. So if I need to stay home because my daughter's school is closed, I get 10 days, right? The first 2 weeks on paid sick leave. That uses 2 of my FMLA weeks as well, because these can run concurrently without the employee's blessing. And then I would have 10 weeks left of paid 2/3 under family medical leave. Let me also add that this emergency paid family medical leave is not adding to the 12 weeks I'm capped at. So you're an employer with 50 or more employees. I broke my ankle playing softball late in the summer, early fall. I took 6 weeks off, and now here I am still within the 12-month rolling year, because everyone, of course, is using the rolling year because that's what you've been advised to do. And I come down with a situation where I need to stay home with my child because her school is closed. I will get 2 weeks of paid sick leave, and then I will be down to only 4 weeks left now of emergency family medical leave. All right. There's some side notes I want to mention, that if you are under 50 employees under both of these, and your existence is placed in jeopardy by providing these paid leaves, there is, I say a method, that's really not fair. There's a concept that has no real guidance on how you do it other than you self-declare, kind of like we do on whether we're essential or not. So of course, when we self-declare, we're all essential. Nobody wants to declare they're not essential. So it's the same thing for the 50 and under, that if you're under 50 employees and giving somebody the paid leave would put your operation in jeopardy of going out of business, then you don't have to provide these leaves. There's been no guidance of any real substance from the Department of Labor on how you're going to prove that if you'd have given somebody one of these paid leaves, you were going under. But it is out there to give some thought to. I want to touch just briefly on something Todd had done too about the unemployment. Again, take everything I say with a grain of salt. I'm an old employer side employee lawyer, but he's hit the nail on the head that unless you're paying somebody in the neighborhood of $65,000 a year, they will be better off not working than working. And there's a method to the madness. The $600 is not a random number. $600 is exactly $15 an hour for 40 hours. It's exactly what the Democrats want to have the national minimum wage be. So to make their point in this time of crisis, they've awarded the minimum wage they would like to see everybody made on top of whatever the employee can get through the state unemployment. So it may serve the economy well in the short term, but hoping that there is a light at the end of the tunnel, it may be difficult to get folks to come back to work. The federal subsidy is for 39 weeks, and most of the states are adopting, whether they were 20 to 26 weeks is the norm, are expanding it to 39 weeks. So that may become an issue for you getting your employees back to work, but we'll save the guidance on how to do that for another presentation. One thing Todd also mentioned was the concept, some banks are suggesting you get a separate bank account to put your payroll protection payment loan money in. The SBA came out and suggested that's exactly what you should do so that you can track where the money's going. So I would encourage you to do that. All right, restoration to work, restoration to your work position after returning from public health emergency FMLA tracks the same return to work guidance that we had from the quote old FMLA, and that is basically you got to get substantially the same position, which us lawyers say is exactly the same position because it's got to be the same place of employment, the same supervisor working with the same co-workers at the same hour with the same pay and the same benefits. So you really are holding a position that, and I will say that if you business gets cut in half and you lay half your people off, and I'm off on FMLA, and I would have been laid off because you're laying the last 10 people hired, and I was one of those last 10, I still get laid off. So I'm not better off than I would be if I had never taken the leave. But basically, you're going to hold my job until I can come back unless that position really has been eliminated. There is a lot of bit of talk about if you have fewer than 25 employees, there's a way to get out of this return to work. And then there's a set of 4 factors the Department of Labor had put up. And as fate would have it, they're exactly the same 4 factors if it does apply. So that's kind of a red herring of this. If you're under 25, you don't have to return somebody. It's not the case. It's the same analysis if you're over 25 employees. I don't know. That takes me through the very basics of what I wanted to cover. My guess is we're going to have some questions that we can go. One thing I do want to add, I don't know if our next speaker if Brent has showed up. I don't want to eat into his time if he's here. But
He's here.
Okay, the teleworking, keep in mind, anybody that can telework does not qualify for any of these leaves. You know, the fact that I don't work at home, for by way of example, here at Barrett, we have 70 people working out of home offices that we set up. So they are teleworking. They don't get paid sick leave if they can work from home. So that's another thing to keep in mind. The DOL has also made it very clear that you not only can ask, but you should be asking for documentation to prove that the individual is off for the reason they stated. They can sign a certification. If they're off because of a governmental order, you can see the order. If they're off because of a physician order, you can see the physician's order. If they're off to care for a child, they have to represent that there's nobody else available to care for the child when they're out. Same thing with an individual. So there's a lot you can do to document this. Thank you.
Thanks, Tony. Brent, Adam's going to open you up, and did we leave much for you here?
Yeah. Can you hear me okay?
Yes.
Yep.
Perfect. I'm going to go ahead and share my screen as well. Hey, Adam, am I showing up on everyone else's screen as well?
You are, but I don't see your screen yet. If you want to go ahead and click that share screen button at the bottom.
Okay, there we go. Okay. Hi, everyone. It's good to see so many familiar faces. Welcome to my office. Also looks a lot like my home. So surprisingly enough, if you do hear an infant or child screaming, fair warning, there's 4 of them back there in a room somewhere. So just heads up on that. So I'm trying to keep them contained the best that I can during this. But my part's pretty cut and dry. So I'll go over it, but I also really just want to share some resources with you. For the last 2 weeks, I feel like Paychex has been just pumping out a ton of resources for banks, for accountants, and also for my business clients. And so I want to just share some of those things with you as well. And then I want to leave lots of time for questions for Tony and Todd and myself. So I'll breeze through this really quickly, but just so you know who I am, I cover all of Northeast Indiana for Paychex. Paychex is now one of the largest payroll providers, HCM, so HR, benefits, insurance providers in the country. We pay out of 1 out of 12 private sector employees. So it's a massive company, and I work with over 600 companies here in the local greater Fort Wayne area. And I've been with the company for over 5 years. And so this is definitely something that we've not been through before. So it's been a learning curve all around. But what I wanted to talk about was the payroll tax deferral piece of this. Like I said, it's pretty cut and dry, but let me go ahead and share my screen. And I've got a tool that I'm happy to make available to you. And what you'll see here is a little grid that we put together for folks. And it's just a nice little tool that I hope, and like I said, I can make this available to you, but it breaks down the different programs that we've discussed today. And it tells about what the credit is, the eligibility, the requirements over here on the left-hand side, the maximum amounts, the speed to get money, the repayment, the covered period, the big benefit of it, and can you use it in conjunction with others? And so in the chat area, I've been seeing a lot of people asking a lot of these questions. A lot of it's covered right here, but like I said, I will make it available to everyone. But really what I wanted to speak into was this payroll tax deferral piece. So this section right here on the right-hand side. So criteria, any employer, right? Because every employer is going to owe that 6.2% Social Security match of the employee payroll. And so you can opt to delay that payment according to Section 2302 of the CARES Act through May 27th to December 31st are the pay period dates. So you can opt to defer that 6.2%. And also I wanted to let you know, I know a lot of you folks may not be using Paychex. You may be using other payroll providers that are out there. So we do honor this. So there's a worksheet that we make available to our clients for this. Payroll providers are allowing their businesses to delay or defer these the Social Security piece of their payroll tax. Okay, so if you are using a provider, that is something the employer is responsible for, notifying the company that they want to defer it. And then also those payments will be made back over the next 2 years. So 50% in 2021, another 50% in 2022. So it's really, if you want to go this direction, that's totally your call, but companies are allowing you to do that like Paychex. Now it's not eligible if you are seeking the PPP loan, right? So that would be one of those things where maybe you defer it for now and then you get approved for the PPP loan. And so you just deferred it for maybe a short window of time, but you can't actually do them in conjunction with the other. And it applies to Social Security, which is 6.2%. When does it become eligible? It's immediately, right? Because you're just deferring that tax payment. And then, but you have to repay it back. So unlike the others that you do experience that loan forgiveness with the PPP loan, this is not something that's going to be forgivable, right? So a lot of the CPAs that I partner with have recommended definitely looking at this option first, the PPP loan option, prior to this, because it's not going to be forgivable. You're just deferring the payments till 2 years down the road, granting that whatever that tax accumulates to, that you're going to have those funds then to pay them. So perhaps, maybe not the best case scenario to opt at first, for instance. Maybe look at this because it's money that will be forgivable if used correctly in their guidelines. So just food for thought on that. Deposits due, obviously, between March 27th and December 31st. And really the big goal, to help you manage cash and keep your employees employed, right? Because as Tony and Todd have both said, The unemployment situation is the first time in American history that we've incentivized employees not to go to work. And we got to keep folks employed. And so if whether you don't get the PPP loan, maybe this is a backup plan, right? So that you can keep your cash flowing to keep these people hired. And one of the things that I did want to add on to the unemployment, we talked a little bit about unemployment, but one small thing I would add into, because it affects a business owner's payroll taxes, is as a new business, you're paying 2.5% of that unemployment until the base amount's met. But it may have dropped down to 0.5 if you don't have a lot of claims coming in, correct? But what's going to happen with all of the unemployment claims that have come in now? A lot of folks are asking, will this directly affect my unemployment rate, my merit rate change? Or will it not affect it at all? Will it be a wash all across the board? So if you go to the Indiana Department of Workforce Development, they have a nice little, answering question there, but their response to it is it's going to be kind of a wash over the whole pool, right? So everyone's unemployment merit rate will probably increase is the feeling that I get from that. Any contributors in there are going to see an increase because of the amount that's being paid out. So heads up on that, but hopefully keep your employees hired. The optimist in me says maybe when you start hiring people back again, maybe you'll have a greater pool of people to hire. So maybe if you have an upper level management or supervisor, someone you want to bring on board, maybe there's an opportunity to have a better candidate. But again, that's just me being optimistic. But either way, try to keep people employed. One other thing I want to share with you real quick before I turn it over for the question and answer section is a website that we have available. You do not have to be a client of Paychex to utilize this tool. And, and I would also, I'm going to put my info up there just so you have it real quick. I hope you can see it. But again, my name's Brent. I'm doing this for over 5 years. Please feel free to call me or email me. I'm happy to make any resource available that we have. We're just here looking out for each other during this time. So, please feel free to give my cell a call or email me at this email. But the Paychex Works website's right here. And it's just a helpful tool that we pump out from DC. We update it constantly. And you may see some of these on my LinkedIn feed as well. But some of the tools here are just latest blogs, things that we have WebExes here. We have CPEs here as well. Different things about how does this affect your handbook? So different things like that are here for you. I'm not going to go into it too much, but there's a help center here that's available. So again, if you have questions on those things, please reach out to me directly. But yeah, at this point, I appreciate you guys' time. I very greatly appreciate being asked to be a part of this. So I'll go ahead and turn it over to you guys at this point.
Great, thanks you, Brett. Adam, you've got a few questions there in the time we have left.
Yeah, absolutely. We have a ton of questions, so I'll try to group them together so that we can hit as many as possible. And then if we don't quite get to something, I think we can work on getting answers to specific questions after the call. But one, Todd, for you, could you talk a little bit more about how PPP would work with an EIDL loan? We've gotten a couple of questions about that.
Unmute him.
Yeah.
Wait a minute, Todd, you're still on mute.
Yeah, sorry, we're having a little difficulty. There we go.
How's that? Okay. I'm not getting experience with the emergency disaster loans. As I understand it, anybody who applies for one of those gets $10,000 immediately, whether they qualify for the loan or not. And I think that's a freebie where they don't have to repay it. But as part of one thing that qualifies in applying for your PPP loan is the amount of any outstanding disaster loan that you acquired in the first part of this year. I can't remember, there's a time frame there sometime between January and March where they allow you to borrow additional PPP money to pay off that disaster loan, which whether that's a requirement or whether it simply says, here's a loan you'd have to repay, now you can borrow forgivable money to repay the other loan. I mean, I think you'd want to do that anyway. So if you have an existing one, I would increase the amount that is one of the items that you can borrow, additional PPP money for, and then pay off the disaster loan that you might have acquired 2 months ago. But I don't know that anybody that, each state, we were just named as the disaster areas because of the COVID, and that only happened, I think 2, 3, 4 weeks ago. So whether anybody has one of those disaster loans in this area, I would be surprised, but it's possible, I suppose.
Thank you, Todd. And then Tony, for you, we've gotten a couple of questions about employees. So if employees have stopped working on their own volition, or if you have part-time employees, how do you calculate employees? Who gets compensation when you're not when you're dealing with folks who are not full-time employees under the definitions in the CARES Act?
Yeah, let's take the first one, which is a little easier. If employees have a fear of working given the current situation, that is not covered under paid sick leave nor the emergency family medical leave. It has to be something more. It has to be an order from a physician, or actively seeking a medical diagnosis with symptoms. So I just don't feel comfortable coming to work. I'm subject to anybody else who's not coming to work the attendance program. For part-time employees, it rolls into what their average wage is. So if I'm part-time employees, I get a different dollar amount under the paid sick leave than I get if I'm a full-time employee, because I get my average hours I would have worked over the 2/3. So if I'm working, by way of example, 30 hours on average part-time, then my paid sick leave will be for 60 hours of paid sick leave as opposed to 80.
Got it. Thank you so much. And then Brett, question just to confirm, I know I've got a lot of comments both in the public chat and then just to me directly complimenting Paychex just on how great they've been to work with. Can you confirm that you will send out the grid that you're showing us now, that you can make that available? I think folks are really interested in getting a chance to look at that themselves.
Yeah, absolutely. I'm happy to. As long as you have a way, everyone's email addresses, I'm sure, Adam, I can blast that and the Paychex Works link out. Yes.
Awesome. Thank you. I know we are running short on time, but Todd, another question for you. The Paycheck Protection Program opened last Friday, and we are now almost a week away from that. If someone hasn't applied for that yet, are they too late? Or will you know if there will be a second phase if they missed this phase, if it is too late for this round?
No, actually the window doesn't open up till tomorrow for the self-employed and the sole proprietors. So, from the numbers I've been seeing touted, I would guess the money's probably good through April or mid-May. I just don't think you want to wait till June. The money may be gone by then, but it's hard to figure out how much pent-up demand there is out there across the entire country, and how many small businesses are going to avail themselves of this opportunity. But there's still plenty of time right now, but I do it now and not wait a month or 6 weeks to apply.
Adam, if I might add there, the
yes,
SBA
please.
Clear, it's first come, first serve. So if you think you might want it, I'm going to echo Todd's comments. You need to get yourself in line. As of noon today, both sides of Congress have indicated that $250 billion is the right number to add to that fund. They're squabbling over what else should be done, so that may slow it down, but it does look like there's going to be ultimately another $250 billion put into that $349 billion fund. But again, echoing Todd's comments, my initial work with my banking clients and other clients is that even that money will be gone before the end of the application time.
Mm-hmm. Thank you, Tony. And then Todd, really quickly, could you just touch on the difference between a sole proprietor and a self-employed individual, because the due dates or the dates to apply for PPP are different for those two groups of individuals.
Right, and it's a little murky. They talk about small businesses. I sent one out this morning where it's a small business, but they have employees. So he reports it as a self-employed person on Schedule C. In my estimation, that's a small business because of the employees. I think the intent was move the sole proprietors and self-employed people, their deadline or their opening of the window to tomorrow, just because they may not have employees, and therefore, they wanted to get the people with employees at the front of the line a week ahead of that. But that's just my guesstimate of why they would have, had two different window openings there.
Well, thank you. Pat, it looks like we've covered most of the questions. I know we are a little bit over now. So with that, I can turn it back to you to any closing remarks you'd like to make.
Well, to everyone who's listened today, it is being recorded. So to check, give us a little time for Adam to put it all together and send it on to each of us. But each of the sponsoring groups will make this recorded Zoom available on our websites if you want to share it with someone else or just go back and clarify perhaps what you thought you heard. You'll also get an email from us. I think our hero, Molly Rommel from Barrett McNagny, will be getting this out to everybody. She's helped us so much in getting set up today. But we'll have the email addresses of our speakers so that if you're interested in talking with them in greater detail, getting their assistance in helping follow through on some of their recommendations, they will each be available to you. Allow me just to thank, besides Todd and Tony and Brent, but Indiana Philanthropy Alliance has hosted us today, shared Adam with us, and given this platform for us to reach 120 some people, plus whoever will listen to the recorded meeting afterwards. I have one last ask of you. We've covered a lot. We want to know as a group if we need to cover more. I'll give you my email address. It's phays@awsfoundation.org. If you want further webinars, if there are topics we didn't cover today that you would like to see covered or more detail on a topic we touched on, please send me an email and we'll evaluate if we've covered everything in one or if there's a need for a second. I know during this time, your time is so valuable. You're covering so much. Thank you for giving an hour with us. And please share the recording so that other people can learn what you've learned today. So again, thanks to Adam, Todd, Tony, and Brent, and IPA in helping us today. The picture behind me reminds us today is Monday, Thursday. We've got the Holy Weekend coming up. Please take care of yourself, take care of your family, take care of your communities, and have a good day.
Thank you, Patty.
Bye-bye.